Oil crossed $110 a barrel on Thursday, and it wasn't the war that sent it there. It was the absence of a plan to end it. President Trump's national address Wednesday night contained no exit strategy, no pathway to reopen the Strait of Hormuz, and no U.S. military commitment to clearing the choke point that carries 20% of the world's oil supply. Instead, Trump told the nations that depend on that oil to take the lead in protecting it themselves. The market had priced in a short war with a clear off-ramp. What it got was a president promising extremely hard strikes over the next 2 to 3 weeks, with no defined endpoint. WTI crude responded immediately, surging past $112 in intraday trade. TD Securities now estimates that nearly 1 billion barrels of crude and refined products will be lost by month's end, with an additional 450 million barrels lost for every subsequent month the conflict continues. Rapidan Energy puts the total net loss at 630 million barrels through June. The physical market is already pricing in the scarcity. Buyers in Houston are paying nearly $120 per barrel for spot deliveries, a $5.50 premium over the May futures contract. That gap reflects not just supply fear, but the collapse of any near-term rerouting option. And with the strait still closed, analysts at Rystad Energy warned that onshore oil inventories could fall to multi-year lows as early as August, removing the buffer that has kept prices from going even higher. Bank of America analysts projected Thursday that headline PCE inflation would surge to nearly 4%.
There is one sector where the Iran war is not a headwind, and it is one that most investors had largely written off. Renewable energy is emerging from this conflict not as an environmental priority, but as a national security asset. The logic is structural. The Strait of Hormuz closure exposed how much of the global economy runs on energy produced in a small number of politically volatile countries. Solar, wind, and electrification produce power from sources that are as it were and controlled by no one. The International Renewable Energy Agency reported Thursday that renewables accounted for 85.6% of all new energy capacity installed globally in 2025, and now make up 49.4% of total world capacity. The UN body's Director General stated directly that countries that invested in the energy transition are weathering this crisis with less economic damage. The policy implication is being absorbed rapidly. Southeast Asian governments from Bangladesh to Vietnam have moved to accelerate electrification and are reconsidering nuclear power timelines. European consumers are rushing to install solar panels and heat pumps at rates not seen since the 2022 energy crisis. In the U.S., the iShares Global Clean Energy ETF has added roughly 1% over the past week, even as $1.5 billion has flowed out of broader clean energy funds, a sign that the money exiting general ESG mandates is being replaced by energy security buyers with a different thesis. The key near-term test is the July 4, 2026 construction deadline under the One Big Beautiful Bill Act, which locks in maximum tax incentives for renewable projects that break ground by that date. If oil prices remain elevated through May, the capital reallocation into domestically produced power could accelerate substantially. The weight of evidence points toward a sustained bid for clean energy on security grounds, but this only holds if oil stays above $90 and the war narrative does not flip suddenly toward resolution. A ceasefire announcement or credible Hormuz reopening would immediately reduce the geopolitical premium and expose the sector to profit-taking from investors who entered on the energy security thesis rather than fundamentals. Watch WTI crude and any diplomatic signal from the 35-nation coalition meeting that the UK convened Thursday. The US did not attend, which itself tells a story about how fractured the international response remains.